Welcome back to Iron Financial, the place where we forge stronger portfolios by hammering right through the market's noise. I'm your lead analyst. Today, we are cracking open the nation's largest egg producer, Cal-Maine Foods, ticker symbol CALM. Now, this company just dropped a quarterly report that, if you just looked at the headlines, you'd think it was a complete and utter catastrophe. I mean, we are talking about profits that have basically vaporized, sales in an absolute freefall, but, and this is the big question, the market decided to send the stock up. This is the kind of paradox we live for. We need to deconstruct this thing, piece by agonizing piece, to figure out if we're looking at a company with serious cracks in its armor or if it's actually in the middle of forging a brand new steel foundation. Whoa, hold on a second. Just stop right there. Let me see if I'm hearing this correctly. You are telling me that a company comes out and reports that its net income, its actual profit, has collapsed by over 90%. That's 90. And the knee-jerk reaction from people who are supposed to be serious professional investors is to smash the buy button? You gotta be kidding me. In what parallel universe is that considered good news? That isn't a market signal, my friend. That is a 5-alarm fire. A stock with numbers like that should be getting absolutely hammered, not climbing up. This whole thing just smells like the typical Wall Street spin machine trying to sell a garbage narrative. I'm going to need a real, hard data explanation because every single fiber of my being is screaming that this headline means abandon ship. And that is precisely why we're doing this analysis. We don't trade on headlines, we don't trade on spin. We build our positions on a foundation of solid fundamentals. Okay, so let's get into the game plan here. We're going to break this down methodically, like a construction project. First up, we are going to face that headline shock head-on. We'll look at the raw, ugly numbers. Then, section 2, we'll start deconstructing those numbers, literally tearing apart the revenue and the earnings to find out what's really going on under the hood. After that, we are going to solve the profitability puzzle. Seriously, where did all the margins go? And then section 4, this is the crucial one. This is where the whole thesis gets forged. We're going to examine the company's new foundation. And finally, we will deliver the iron verdict. Is this a rock-solid opportunity, or is it a dangerous trap waiting to spring? Let's get to work. All right, section 1. It's time to look at the numbers that caused all this confusion in the first place. I want everyone watching to see exactly what the market saw at first glance, because you have to understand the initial shock before you can possibly understand the reaction that followed. You know, this is the point where most people stop reading. They see the headline and they move on. But here at Iron Financial, this is where our real work begins. These numbers you're about to see, these are the numbers that should have sent investors running for the hills. And let me tell you, this slide tells a brutal, brutal story. Let's not try to sugarcoat this at all. Look at net sales, cut in half, down a staggering 53%. Look at gross profit. That's the money left over after you actually make and sell your product. It fell off a cliff, down over 83%. But the real gut punch, the number that makes your jaw drop, is net income. It practically evaporated. It collapsed by over 90%, from more than $500 million all the way down to just $50 million. And what about earnings per share? Absolutely annihilated. It went from over $10 a share to a measly $1.06. If you look at these numbers in isolation, they are the vital signs of a company in a complete and total tailspin. There is simply no other way to read this table. And yet this happened. The stock jumped. It makes no sense. How? Who in their right mind looks at a 90% profit collapse and thinks to themselves, you know what, now seems like a fantastic time to get in? This is exactly the kind of bizarre market action that makes regular retail investors lose their shirts. They look at this, they see an absolute disaster, but then the stock goes up and they get completely confused. So what is it? Is the market fundamentally broken? Is this some kind of weird meme stock nonsense going on? Because from where I'm sitting, rewarding an 83% drop in gross profit with a stock bump feels completely, utterly disconnected from any economic reality I understand. This is a massive, flashing red flag. That is exactly the right question to be asking. And the answer is that the market isn't broken, it's just looking deeper. It's looking past the messy demolition of the old structure to see what's being built underneath. So let's do the same thing. It's time to put on our hard hats and deconstruct these numbers, starting with that massive revenue collapse. We have to get past the noise of the year-over-year comparison and start inspecting the core components of what was actually reported versus what Wall Street expected to see. And this right here is where context becomes everything. Okay, so to really understand what happened this quarter, you have to understand the context of last year. And the key thing to know is that the numbers from last year, from Q3 of fiscal 2025, were not normal, not even close. They were the direct result of what we call a black swan event, the highly pathogenic avian influenza, or HPAI. It was an absolutely devastating outbreak that wiped out a huge portion of the entire nation's egg-laying hens. And you know what happens next, right? Basic supply and demand economics took over. Supply was decimated while demand stayed high, and the spot price for a dozen eggs skyrocketed to historic, completely unsustainable levels. Cal-Maine, being the biggest producer in the country, just happened to be in the right place at the right time and reaped a massive one-time windfall. So trying to compare this quarter to that one, it's like comparing a normal Tuesday to the day you won the Powerball lottery. It's a fundamentally, deeply flawed comparison. Okay, fine, I'll give you that. Last year was a fluke, a total anomaly. I get it. But even if we completely ignore last year and just look at the expectations for this quarter, the story still isn't as perfect as you're making it out to be. The big consensus revenue estimate, the number most people were watching, was around $678 million. Cal-Maine came in at $667 million. That's a miss. Now, it's not a huge miss, I'll grant you, but it is still a miss. So you can't just sit there and tell me this is a simple story about beating low expectations, because on the most watched number of all, revenue, they didn't even clear the main bar. Yeah, they beat some of the lower-end forecasts, sure, but they missed the big one. The case for this stock pop isn't as solid as you're trying to make it sound. And you're absolutely right to point that out. The top-line revenue story was admittedly a bit mixed, but this is exactly where the professional money looks past the top line and digs deeper. You've heard the old saying on the street, revenue is vanity, profit is sanity. Now look at the earnings per share. The consensus on Wall Street was for 89 cents. Cal-Maine delivered $1.06. Now that is not a small beat. That is a massive 19% beat. So what does that actually tell you? It tells you that with slightly less revenue than people expected, the company managed to generate significantly more profit. That screams operational efficiency. It means their cost management, their pricing structures, their entire internal machine is running way better than anyone on the outside anticipated. And that right there is the first real sign of underlying strength beneath that ugly surface. Okay, an EPS beat is a solid point, I'll admit that. But it doesn't just erase the rest of the disastrous report. Even if you want to write off last year as an anomaly, that 83% collapse in gross profit this year looks a lot like a structural problem, not just a simple comparison issue. So that brings us to the next big question we have to tackle, the profitability puzzle. Where in the world did the margins go? And more importantly, can this company actually make any money when egg prices aren't at historic, once-in-a-decade highs? A structural problem is, putting it mildly, take a look at this chart. This isn't a decline. This is a total collapse. Last year, during the Great Egg Apocalypse, they were running a gross margin of over 50%. Think about that. For every single dollar that came in from sales, more than 50 cents was pure gross profit. That's insane. Now, it's under 18%. So for every dollar in sales today, they're keeping less than 18 cents to pay for everything else. This proves my point entirely. The company's profitability is completely 100% dependent on a volatile commodity price that they have zero control over. As soon as prices return to normal, their margins get absolutely crushed. How is that a stable foundation for a long-term investment? To me, that looks a lot more like a house of cards ready to topple over. And you are correctly identifying the core risk of the old Cal-Maine business model. The gross profit margin is the purest measure of a company's production efficiency we have. And yes, that massive stomach-churning drop was driven almost entirely by one single factor. The average selling price for their shell eggs fell 56.5% year over year. When the price of your main product gets cut in half, your margins are going to be destroyed. That is the harsh reality of the commodity business that you're describing. But the real question for us as investors isn't whether the old house of cards is shaky. The question is, what if the company is busy building a new house made of steel right next to it? And this quote right here from CEO Sherman Miller, this is the pivot point for this entire thesis. You need to read it very carefully. He's not sitting here making excuses about low egg prices. No. He's saying this downturn was a test of their new strategy. He is explicitly stating to the market that their performance is not just about the spot market anymore. It's about how they manage their mix of products. He is basically broadcasting to the market, we know the commodity business is volatile. We get it. That's precisely why we are deliberately re-engineering this entire company to be less dependent on it. This is the exact signal that the smart money was waiting to hear. So this brings us to the absolute core of the bull thesis. We're calling it forging a new foundation. Because while the old commodity-driven business is showing some serious cracks, the numbers hidden inside this report show that Cal-Maine is building a new, much stronger structure right alongside it.
This isn't about sitting around and hoping that egg prices go up. No, this is a deliberate, calculated, strategic pivot into higher margin, more stable businesses. And the data from this quarter shows that this plan isn't just working, it's actually accelerating.
First, let's look at the old business. This is the part of the company that everyone worries about, and for good reason. Conventional shell egg sales. We're talking your basic, low-margin, highly volatile commodity eggs that you see everywhere. Sales in that division cratered. They were down a catastrophic 72% year over year. This number right here represents the past. This is the demolition phase of the project.
But now, look at the new business, the one they are building for the future. We're talking about prepared foods. This is things like pre-cooked egg patties for breakfast sandwiches, liquid eggs for restaurants, things like that. These are value-added products with much higher, more stable margins that are far less tied to the daily spot price of a dozen eggs. Sales in this segment didn't just grow, they absolutely exploded, up over 441%. This is the core of their strategic shift, laid bare in just two numbers. They are actively shrinking the bad, volatile business and exponentially growing the good, stable one. And let me be clear, this is not some tiny experimental side project. This is a fundamental shift in the company's revenue DNA. Just look at this new sales mix. Conventional eggs, the volatile part of the business we've been talking about, are now down to just 42% of total sales. Meanwhile, the higher margin segments, that includes specialty eggs like cage-free and organic, plus the prepared foods we just talked about, now account for over 52% of total net sales. For the very first time, more than half of the entire company's revenue is coming from the more stable, value-added side of the business. This is the transformation happening in real time right before our eyes. Okay, I have to concede that 441% growth is undeniably impressive, and the sales mix shift is very compelling. But a strategy is, at the end of the day, just a plan on a piece of paper. A multi-year construction project like this is incredibly expensive. It requires heavy capital investment, perfect operational excellence, and most importantly, the ability to withstand market shocks along the way. A company's strategy is only as strong as its financial foundation. So the question is, do they really have the strength to actually pull this off? Or are they going to run out of money halfway through the build? That is the single most important question you could ask right now. And the answer is absolutely unequivocal. Cal-Maine's financial foundation isn't just strong, it's made of solid rock. The balance sheet is the bedrock that makes this entire strategic pivot not just a possibility, but a probability. This is what separates a company like Cal-Maine from its weaker competitors who simply can't afford to make these kinds of long-term strategic investments. And the cornerstone of that entire foundation is this one beautiful number, 0. In an economic environment of rising interest rates where debt is a heavy anchor dragging so many companies down, Cal-Maine has none. Zilch. They owe nothing to nobody. This gives them an immense amount of flexibility. They can invest in new facilities, they can make strategic acquisitions like they just did with Echo Lake Foods, and they can return cash to shareholders all without ever having to go ask a banker for permission. This, right here, is the very definition of pure financial strength. And that strength goes so much deeper than just a lack of debt. Look at these ratios. Their current ratio is over 8. That means they have $8 of liquid assets for every $1 of short-term liabilities they owe. They are swimming in an ocean of cash. Their Puderesky F-score, which is a 9-point checklist of a company's financial health, is a perfect 9 out of 9. Their Altman Z-score, a formula that's used to predict the risk of bankruptcy, is at 9.82, which signals an extremely low chance of any financial distress. And on top of all of that financial perfection, the stock is trading at a price-to-earnings ratio of just 3.34, near a 2-year low. So what you have is a company that is financially invincible, is successfully executing a major strategic pivot, and it's potentially on sale. That is an incredibly powerful combination. Which brings us finally to our last section, the iron verdict. We've looked at the headline shock, we've deconstructed the numbers, we've solved the profitability puzzle, and we've inspected the foundation. Now it is time to weigh all the evidence. Is Cal-Maine Foods a generational opportunity to buy into a business that's transforming itself for the better? Or is it a classic value trap, doomed to repeat the volatility of its past? Let me lay out the bull case for you, the argument for why the market pushed the stock higher and why it was right to do so. First, the strategic pivot to higher margin products isn't just a theory and a presentation. The numbers prove it is working. The mix shift is real and it's accelerating. Second, the company's foundation is a fortress. That zero debt balance sheet and those stellar health metrics mean they can weather any economic storm and fund their own growth without blinking. Third, Even in what was supposed to be a down quarter, they still generated over $100 million in cash from their operations. This thing is a cash machine. And finally, the valuation appears cheap. The market, in this case, is correctly looking past the ugly year-over-year numbers and is rewarding the company for its clear strategic progress and its financial invincibility. But let's not get ahead of ourselves here. The bear case, the trap, is still very real, and we have to acknowledge it. You can't just ignore the fact that almost half their business is still chained to the extreme volatility of commodity egg prices. That is a core risk that has not vanished. The margin pressure on that conventional side of the business is severe, and there is always the black swan risk of another avian flu outbreak that could disrupt their entire operation overnight. And finally, execution risk is always a factor. Just because they went out and bought a company like Echo Lake doesn't automatically guarantee they can integrate it successfully and make it profitable. Those are real risks. So that is the ultimate question that we are left with. Was the market right? After hammering through all the data, the iron verdict is this. The risks are real, and you should not ignore them. But the evidence for the bull case is stronger. The cracks you see in the headline numbers are not signs of a crumbling foundation. They are the signs of a planned demolition of an outdated, volatile business model. The company is actively and successfully using its immense financial strength to forge a new, more durable foundation based on value-added products. The market's positive reaction was not irrational. It was a forward-looking acknowledgement that Cal-Maine is building a more predictable, more profitable, and a fundamentally stronger company for the long term. That's our analysis. Stay strong and stay invested. We'll see you next time on Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.